Welcome to this week's episode of Jonathan on Money. This is episode number 141. This episode should be dropping right before the new year. In fact, it's my last podcast of the year, so I hope everyone had a meaningful 2025 and wish all listeners a wonderful new year filled with health, happiness, and only good things. And speaking of the new year and fresh starts, before jumping into this week's show, consider laying the foundation for a successful financial future by purchasing my new book, which is geared towards toddlers, but good for folks of all ages. It's called D is for Diversification, the ABCs of Personal Finance, and it's available now on Amazon or at jonathanonmoney.com. The book is a fun way to plant the seeds of financial literacy, perfect for families with young kids or anyone brushing up on the basics, and a memorable gift that helps raise money smart kids. And your support really does mean the world. And if you enjoy it, I'd be grateful for your 5-star reviews on Amazon. Before jumping to this week's episode, I'd like to share that my upcoming winter live webinars will continue on Thursday, January 8th at 8:30 a.m. featuring Martin M. Shenkman, founder of Shenkman Teats, based in New York. Marty will be speaking about asset protection in 2026, SLATs, DAPs, SPATs, and more acronyms. This program will also offer CP and CLE credit to accountants and attorneys based in New York and New Jersey, and I'll be sure to include the registration information in the show notes to this episode. Okay, now for today's agenda. My talking points this week will reflect on the $10 sufganiya. Our quote this week is from Chris Rock on what wealth really means. And I'll spend the last half of the episode answering listener questions, including the compensation package of the principal of your child's school. And finally, we'll end with an actual idea to implement to your investing life, where we'll discuss year-end Roth IRA conversion considerations. With that, let's jump into this week's talking points. So we finished celebrating Hanukkah not too long ago, and there has been something I've been pondering, which is the $10 sufganiya. After all, over Hanukkah, there is a custom for Jews to eat fried foods to commemorate the miracle of the oil in the Beit HaMikdash lasting 8 days instead of just one. This is not just a delicious and trendy minhag that should be taken lightly. In fact, in the 12th century, the Rambam relayed that his father, Rabbi Maimon ben Yosef, wrote to him that one must not make light of the custom of eating sofganim, fritters, on Hanukkah. It is a custom of the Kadmonim, the ancient ones, he wrote. I personally take this custom quite seriously as well. For the past few years, I've sampled sufganiyot from a wide variety of bakeries around the New York area. Many Jews are equally serious about this minhag, with the sufganiyot becoming more elaborate and decadent each year, and their prices increasing along with their creativity. Our ancestors in the Alterheim would have undoubtedly been blown away by the countless flavors, from salted caramel and lotus to red velvet, cookies and cream, and more. However, I must admit that while I admire all the innovation in this food group last year I became disenchanted with these fancy pastries. It was just too much, spending $10 or more on a donut that was so rich, heavy, and caloric just seemed excessive. And I confessed to my wife by the end of Yontif that next year I just want to stick to plain classic jelly donuts, which I did this year. Sufganiyot are just the tip of the iceberg for many from families when it comes to going overboard on Hanukkah. A combination of presents every night, excessive parties with too much food, and elaborate decor have become a distraction. People forget the holiday is really about recognizing the triumph of Jewish identity and religious freedom over oppression. This should be especially relevant today given a rise in anti-Semitism and baseless hatred against the state of Israel. That theme is what we should remember as we light the menorah and eat the symbolically oily foods, but all the overindulgence seems to take away from that important message. The trend towards extravagance, ostentatiousness, and high prices is also relevant in the investment world. I struggle against it with clients. I'm advising them to stick to a sensible investment program while they're lured by approaches that seem more exciting. The appeal to participate in flashy and opaque opportunities is something that is prevalent in the firm world and results in major financial losses every year. Everybody has a friend who could get them access to a real estate, private credit, cash advance, hedge fund, private equity deal at a family and friends discount. These schemes are all fundamentally the same. A naive person is promised mid-teen returns with minimal risk and most inevitably will lead to big losses. As I say often in my writing, videos, podcasts, and while working with clients, you don't need to do anything fancy to achieve your financial goals. You only need to, one, stick to plain vanilla, boring investments like stock and bonds, Two, use mutual funds or ETFs to get this exposure. And three, stay the course over the long term. Remember, you could accomplish everything you want in life and amass a vast sum of money by sticking with the above process and avoiding the more exciting opportunities that plague our communities. As economist Samuelson once said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. If you are bored by your investment strategy, chances are that you're on the right track. The beauty in both sensible investing and celebrating Hanukkah is that the best course of action is easily achievable by the masses. A $2 fresh jelly donut and lighting the menorah are the optimal ways to recognize the miracles of Hanukkah. The $10 sufganiya presents every night, and decked out parties are only distractions from what is actually important. Similarly, a boring ETF or mutual fund is all you need to achieve your financial goals and grow wealth. The other vehicles like real estate syndications, private credit, and hedge funds may be more fun to schmooze about with your friends at the Kiddish Club. They will likely not help you achieve your goals. During Hanukkah every year, let's recommit to celebrating light over darkness, transparency over opaqueness, simplicity over complexity, boring over exciting, and modesty over flashiness. Embracing these foundational principles will lead to Hiddur Mitzvah as well as financial success. Okay, those are the talking points this week. As a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Chris Rock. For those who don't know, Chris Rock is a stand-up comedian, actor, writer, and filmmaker known for his sharp, socially aware humor and commentary on race, politics, and relationships. He was born in 1965 in South Carolina and raised in Brooklyn. He rose to fame on Saturday Night Live in the early 1990s. His breakthrough came with an HBO special called Bring the Pain, which earned him major acclaim and multiple awards. Rock went on to create Everybody Hates Chris, star in numerous films, and became one of the most influential stand-up comedians of all time. I had the good fortune of hearing Chris Rock at an investment conference, of all places, 7 or 8 years ago, and it was really quite an enjoyable experience. Rock once said, "Wealth is not about having a lot of money. It's about having a lot of options." This quote captures a core truth of modern financial planning, which is wealth is not defined by the amount of money you have, but by the freedom and flexibility it gives you. His insights reframes wealth from a static number to the ability to choose how you live, work, give, and spend your time. This is a message I try to express to my clients, emphasizing that true wealth is measured by the freedom to say yes to opportunities and no to obligations that drain you, whether that means leaving an unfulfilling job, taking time for family, choosing where to live, or pursuing passions without hesitation. In this sense, options, not opulence, are the real currency of wealthy life. Rock's perspective also highlights that the richest individuals are not those with the largest portfolios, but those who control their time, the scarcest resource. This framing aligns naturally with behavioral finance, values-based planning, and legacy thinking, making a powerful teaching tool for clients and families. At its heart, the quote invites a simple but profound question. Does this financial decision increase or decrease your future options? Decisions that expand optionality tend to build lasting wealth, while those that limit it warrant caution. So often people ask me why they should save 10 to 30% of their income for their future. And the answer is even if you enjoy what you do, you may want more options in the future. Options to cut back, options to pursue other interests, options to spend more time with your family or travel, etc. Accumulating wealth will give you options, and having optionality is so important to elevate the quality of one's life. Okay, now let's jump into this week's financial questions. If you do have a question, feel free to submit it to me and it may be answered in a future episode. Okay, the first question. Do you ever wonder how the economy and market would have turned out if Kamala Harris won the election, and think about how the country dodged a bullet? I spend no time thinking about Kamala Harris. I haven't thought about her since the election. In general, I spend little time thinking about the past or how things would have turned out. This is especially true from an investment perspective. However, it's quite common for investors to wonder about what would have been. If only they bought Amazon at the IPO price. If only they bought Bitcoin when Satoshi invented it. If only they had more stock exposure coming out of the financial crisis. If only they had more money in technology stocks. If only they owned less international stocks from 2009 to 2023. If only they owned more international stocks the past 2 years instead of so many US stocks. You can play these games all day in many different areas of life. This is a bad approach. We don't live in the past. We live in the present and we plan for the future. No one can make decisions with the benefit of hindsight. Instead, make the best decisions you can with the information you have available. Thankfully, since the election things are working out, we did have a big dip in the markets on Liberation Day for a few weeks, but the market came roaring back, and it seems like we may have done some better trade agreements and with various nations due to that period of time. All the living hostages have been released from Gaza, and the war with Iran only lasted 12 days. Most people don't even remember it because it was so short. And let's not forget about peace between Rwanda and Congo. Can things be better? Sure. Could things be worse? Definitely. Will Trump win the Peace Prize for his efforts and trigger many people? A strong possibility that will be quite entertaining. Next question. Doesn't it bother you that capitalism has left so many people behind? Socialism, while not perfect, is certainly a better way of lifting up the masses. Wouldn't you agree? No, I wouldn't agree because it's not true. Give me one example where socialism on a mass scale has improved the life of its citizens. You can't. North Korea versus South Korea, Cuba, Soviet Union. What about China? China is an interesting example. While China is governed by a communist party, it introduced market reforms in the 1980s, allowing private enterprise and foreign investment. These capitalist style reforms lifted over 800 people out of poverty, according to World Bank. However, inequality increased and the Chinese people are still oppressed and brainwashed. I've been there. I spoke to people there. I got a glimpse of what goes down. Also, who the heck wants to move to China over the US? The answer is no one. Capitalism works because it is the most effective system for preserving both economic and political freedom. Capitalism allows individuals to make their own economic decisions like what to buy, where to work, how to invest. The decentralization of power prevents the state from having too much control over people's lives. In a capitalist system, the pursuit of profit encourages businesses to innovate, improve efficiency, and meet consumer needs. This leads to better products and services without government interference. To quote the Gadol Hador Milton Friedman, a society that puts equality before freedom will get neither. A society that puts freedom before equality will get a high degree of both. Capitalism isn't perfect, but it sure beats the other options out there, especially socialism. Okay, next question. The principal of my child's yeshiva, which will remain nameless, makes over $400,000 a year. I'm not sure of the exact amount, but I know it's over 400,000. Don't you think it would make sense if administrators like this took a pay cut to make yeshiva tuition more affordable? Probably not. I don't know the financial situation of the school you're referring to, but cutting one person's pay won't magically make all the people that are on financial aid be able to afford tuition payments. I also don't know what the going rate for a principal at a yeshiva is these days. However, it's a tough job, an important job, and you'll need an attractive pay package to attract top talent. Imagine having the task of inspiring kids to learn Torah, learn secular subjects, not turn them off from God, all while dealing with administrative matters, personnel issues, kids with behavior problems, and psycho parents who all think their kids are brilliant and special when you know that they're not. Not many people can do this job well. Therefore, a higher salary than other jobs is to be expected for this role. You're angry because you're jealous. Spend a few minutes to think through your hypothesis, and you'll realize it doesn't make sense. Next question, I should say. I have money at a large national firm, a regional firm, and a boutique. I know you think it makes sense to keep investments consolidated. My question is, why do you believe that this approach doesn't make sense? I now have exposure to all the various benefits that each firm has to offer. One of the benefits of working in finance for the nearly 20 years and working at two large firms and one regional firm and now running my own independent firm is I could speak from a place of authority on this. This is the truth. There's nothing special about the large and regional firms. You don't have access to better things or more things. The only thing you do have is the privilege of working with somebody who's pressured by management to sell certain products and strategies to help beef up the company's bottom line. That's the goal of these firms. These firms have nothing to offer other than conflicts of interest, layers of fees, and product pushing. I don't believe the financial advisors are to blame. It's just the way the incentive structure is set up, and they are forced to do things that don't put the clients first. The investment industry is democratized. Anybody can access the best products. The key is knowing what you are doing from an investment and financial planning perspective. That's where hiring the right person helps. Spreading your money across various firms is a mess and won't improve your financial life. Next question. This may sound silly, but I'm extremely not satisfied with the interface on my online portal with my broker. I like working with her, but the online dashboard stinks. Is it worth moving for that? No, it's not worth moving for that. Furthermore, and this may sound weird, it may be better if it's not great, since that will mean you check your portfolio less frequently. The folks that check their investments all the time will, one, drive themselves crazy, two, not accomplish anything productive, and three, may lead to making bad decisions. Just look at Robinhood's dashboard. It's amazing and sleek. However, the goal of Robinhood is to get people to trade a lot. That's not the way to make money. In fact, it's a good way of losing money. The people that do best are those that decide on an investment strategy, tweak it when necessary, which should be infrequently, and stick with it over the long term. A great online interface may be pleasing to look at, but it may make you check your portfolio more often. As long as you get statements you could glance at every month to see where you're holding, or a performance report from your advisor whenever you ask for it, and your advisor gives you good advice when you ask for it, then you're in good shape. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me, and perhaps my team and I can help you. The best way to get hold of me is via email at jonathan@parkbridgewealth.com. And finally, I'd like to end with a timely and natural idea that listeners can implement to their own financial lives. Today's timely idea is going to focus on Roth IRA conversions, which have been quite popular the past few years. A few thoughts on this. First, for some background, this is the process of transferring retirement funds from a traditional IRA, SEP, or 401k into a Roth account. Since a traditional IRA is tax deferred, while a Roth is tax exempt, the deferred income taxes due will need to be paid on the converted funds at the time of conversion. There is no early withdrawal penalty for this strategy. The key is to evaluate your personal tax situation. This strategy may be beneficial if a saver believes that the postponed tax liability in the traditional account will be more onerous as retirement approaches. For example, if they think tax rates will go up, they move to a higher tax state, or if they will be earning a higher income in the future. If you were laid off this year, Roth conversions may be worth considering. Since you may now have a lower income than usual, however, be mindful that if paying the tax bill now is too burdensome, this may not be a good option for you. Be sure to sit down with your tax advisors, determine how much income you can be realized within your current tax bracket before creeping into the next tax bracket to assess how much in traditional retirement funds to convert to a Roth. And just a word of caution, Roth IRA conversions and a related strategy, the backdoor Roth contributions, are both popular subjects to discuss around the water cooler. Remember, just because your friend or know-it-all brother-in-law are implementing the strategy does not mean it makes sense for you. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.